Most traders think they need a better strategy, better entries, better indicators, better signals. I used to think the same thing, but the thing that actually saved my account wasn't learning how to enter trades, it was learning how to protect the capital I already had. So in this video, I'm going to walk you through exactly how I use my journal to manage risk, using trades I took, and more importantly, real mistakes I made. And as we go through this, pay attention not just to the profits, but to the rules, because the rules are what keep you alive long enough to see consistency. Before we dive into numbers, let me give you short definitions so everyone's on the same page. Profit target is the price you plan to exit for a profit, or the price you actually exited. Stop loss is the price that, if hit, invalidates your trade. Initial target is the expected dollar profit based on your entry and profit target. Trade risk is the dollar amount you risk if stop hits or you close the trade in loss. R multiple is the ratio between the reward and risk. So a 2R trade, you make twice what you risked. Planned R is the R you planned before entry. Realized R is the actual R calculated when the trade closes. The most important and fundamental risk management rule I follow is risking only 1% of account equity per trade. I knew this for years but didn't respect it. I blew a few accounts. Once I enforced 1% consistently, I never blew an account again. Treat it as a guardrail, not a suggestion. So now every trade you're about to see starts with that same foundation, predefined risk. I'll walk through 3 trades that highlight my risk management: a textbook winner, a deviation where I broke rules, and a disciplined scalp that shows practical risk management. I'll show some simple math and then we'll pull the R multiple report to see the big picture. Let's see our first trade. Bitcoin, clean breakout. It had clearly defined support and resistance. The price broke above the resistance and retested it. I entered when the price bounced up. Entry price is $89,740. Stop loss at $89,300, very close to the resistance. Take profit was set at $91,300. Expecting strong push out of the consolidation. I risked $45 for a reward of $155. At the end, the trade hit the target price and it closed my position. I realized 3.42 R, a solid clean profit of $150. I marked this trade as reviewed, gave it a 5 out of 5 stars, not because it won, but because it was executed correctly. Tagged it with my breakout setup. The time frame was 15 minutes. To maintain a clear record, I noted this trade along with a summary of the risk parameters and key performance notes for future reference. Next, we'll analyze a swing trade on Ethereum Classic, utilizing VWAP and RSI. This is one I keep in the journal specifically as a reminder of how risk management breaks down. Entry was at $24.58. Stop loss order was set to $24.03 with small risk of $56 and initial target of $280. Planned R multiple was 5R, but after a long losing day and my head wasn't clear, I moved the stop wider and then held on hoping it would come back. Price moved against me. Risk doubled, and ultimately the trade hit the new stop and I lost $90. The realized R became -1R. That single behavior, moving the stop, turned a manageable loss into a big drawdown. Felt much heavier because I broke my own rules. Rated it as a 4 out of 5. I tagged the trade as swing setup, revenge trading from the mistakes category, and 1-hour time frame. Once my head cleared, I wrote a detailed postmortem on exactly how an emotional mistake turned a small loss into a big problem. The last trade we'll review is a Binance coin scalping trade. Momentum set up on a strong long trend. I used volume delta to confirm that the buyers are in control. Combining it with MACD confirmed the expansion. I opened the position at a price of $871.60. Stop loss order at $864.30. Trade risk was calculated around $36 with expected profit of $55. Planned R multiple is 1.5R. The real lesson here is how I managed the trade after it moved into profit. Once the price reached about 1.2R, I partially closed half my position, moved the stop on the remaining position to break even. At that point, the worst-case scenario was no loss, and from there, I just let the trade play out. Eventually, it reached the full target, around 1.5 R. It dramatically reduces emotional pressure and protects capital during volatile sessions. At the end, I wrote a summary note for the well-executed trade. I will be using it to perfect my executions. Now that we know the process of how I manage and track my risk, let's see the R multiple report. Most of my winners live in the plus 3R to 4R bucket. When I look at this report, I can see exactly where my winners live, where my losses cluster, and most importantly, where my behavior changes outcomes. For example, when I filter trades tagged with revenge trading, the R distribution shifts dramatically toward larger losses, and when I see more trades drifting into the -2R zone, it tells me risk discipline is slipping, long before the account balance reflects it. That's the feedback loop journaling gives you. So that's what my actual routine looks like while trading. During a trade, I leave short execution notes, especially if I feel tempted to interfere. After the trade closes, I finalize the stop and target, record the realized R, and write a short review focused on behavior and technical parameters. Then every week, I run the R multiple and mistakes reports. If I see losses expanding beyond planned risk, I don't change strategies. I tighten my rules, because risk management isn't about predicting markets. It's about controlling yourself. At some point, I stopped asking, how can I make more on the next trade? And started asking, how do I make sure I'm still trading months from now? That's what risk management really is. Stops, targets, and R multiples aren't there to predict the market. They're there to protect me from myself. From oversizing, moving stops, and turning one bad trade into a bad week. Journaling made that discipline real. When every trade has planned risk and a realized R, patterns show up. You see when you follow the plan, and when you don't. Over time, losses become controlled, emotions quiet down, and consistency stops being a mystery. That's how risk management protected my capital. Thanks for watching.